One of the biggest misconceptions that we come across in the world of expatriate tax is double tax treaties, and a lot of individuals will get in touch to say, oh well, I'm paying tax on my Australian rental income in Australia because there's a double tax treaty between the UK and Australia that prevents double taxation. That's not quite true. So there is a double tax treaty in place between the UK and Australia. It does prevent double taxation. However, what it doesn't do is stop both countries from taxing that income. So the double tax treaty itself is between the two countries. It will decide A, which country gets the right to consider you as a resident in that country. It will also dictate which country has the right to tax certain sources of income. So for example, pensions quite often are only taxable in one country, but depending on the double tax treaty, it might be the country of residence, it might be the country that the pension derived from. However, in an instance like rental income, usually the double tax treaty will tend to suggest that both countries can tax it, or the country in which the property is located has the right to tax it, and the country of residence isn't forbidden from taxing it. What would happen in an instance like that is that if the property is located in Australia, Australia would have the primary taxing rights. So for example, if you received £5,000 worth of rental profits in Australia and Australia taxed you £1,000, when the UK come to tax the rental profits, they might look at it and go, okay, well, we want to tax you £2,000, but we can see that you've paid £1,000 of tax in Australia. And as a result, what we'll do is you only have to pay the extra £1,000. So overall, you'll have paid £2,000 worth of tax, but £1,000 of it will have been paid to Australia and £1,000 of it would have been paid in the UK. If we looked at it the other way around and Australia wanted to tax you £1,000 but the UK only wanted to tax you £500, then in that instance the UK would say, right, we want to tax you £500 but we can see that you've already paid £1,000 worth of tax in Australia, so we're not going to tax you anymore because you've already paid your fair share of tax. What that would mean is you then pay only the £1,000 of tax to Australia, and effectively you pay the worst rate of tax between the two countries, but you don't pay double the tax. If you need any help in terms of working out which country you should be paying taxes in, then please do feel free to get in touch with us.